Welcome back to the Economic Analyst channel. In this next tutorial, which is tutorial 2, I'm going to go over the essence of what I have used as a foundation of theory to predict the outcomes of our economy and the global economy based off of economic data, and that is the Austrian business cycle. So if you have been listening to my videos, I'm sure a lot of you who have been very astute and knowledgeable about the Austrian business cycle theory have picked up that my rhetoric is inherently Austrian. But I think it's prudent and important to teach you the basics of the theory, the basics here. And that way you get a better understanding of where I'm coming from, and whether you choose to accept or reject the Austrian business cycle theory is up to you. But then you'll be able to judge my outlook on things and the predictions that I make off of that theory as well. And you can also use that theory as a foundational tool to understand what's going on in the world from your perspective too. And from that point, you can build off and pivot from there. So the Austrian business cycle theory is of course been commonly called a theory of booms and bust. Okay. Hang on one second, let me get this slideshow going. The most famous economist that has been attributed to the creation of the Austrian business cycle theory is this man here, and that is Friedrich Hayek. Actually, it was his predecessor, really, Ludwig von Mises, they're both Austrians, that really created the foundational structure of the Austrian business cycle theory. I hold Ludwig von Mises as being the greatest economist to have ever lived because he came up with this ingenious insight. But Hayek popularized it when he argued with Keynes in the 1930s about the causes of the Great Depression and what can be done to cure us of that disease here. So this is Hayek's quote here about what he would talk about. He commonly said, "Booms have always appeared with a great increase in investment, a large part of which proved to be erroneous and mistaken. That, of course, suggests that a supply of capital was made apparent, which wasn't actually existing." We'll get to that in just a second. So it starts here, the theory starts with an idea called credit expansion. Okay, this has to deal with monetary policy. Essentially, increases in the money supply enter the economy through credit markets, and the central bank will literally lend money into existence. So if you have a central bank entity like the Federal Reserve, they will print money, create new money, and that enters the economy. And the whole idea here, and these graphs have been depicted by Roger Garrison. He's really been the one more or less to depict the Austrian business cycle theory and graphical framework. Shows an increase in credit along the demand curve, as you're going to see in the graph in the bottom right in just a second. So let me put it here. But the new money that will enter in is masquerading as savings. So if you watched my previous tutorial, the essence of classical theory is that savings drives economic growth in the long run, because an increase in savings means an increase in investment of developing capital goods, which can be used to augment and increase consumer goods. To give you an example of capital goods, you could think about Henry Ford's production lines here. In order to invest in those tools and equipment to mass produce cars, which would be a consumer good, we had to save money, which would be used to invest in Henry Ford's facilities to build those, and other facilities to build those goods, which Henry Ford would buy to then make the car manufacturing consumer good. And what those do is that they save on labor. So they end up, if we did not have capital goods, we would all live like the Amish and we would all be out in the fields picking up food. But because we do have capital goods, we're able to save on labor, which enables our labor to go use and produce something else. That's the essence of economic growth. We're able to provide for our basic needs through capital goods like food and water and shelter, so that we can go out and do other things. Hell, we've got labor now that goes out and does sports entertainment for us, with professional basketball and football players. So we're actually able to have more entertainment and have labor devoted to that because our needs are taken care of. And how is that done? through capital goods, which is provided by savings. But when the central bank decides to print money, it fakes this savings increase. It gives you the illusion that there's more money, more savings, more devoted resources away from consumption to production. And this augments in an increase in the money supply that goes into the investment markets. Greenspan's picture here is depicted by Garrison because the most famous recent example of this kind of boom that is really very Austrian in nature has been the housing bubble that was done in 2005 and 2008. So here you can see that when the central bank increases the money supply, notice that the blue savings curve shifts down and to the right. So there's this increase in savings, which then lowers the interest rate, and it makes more money available to be invested. But in reality, if you watched the second dot move down and to the left, that dot actually depicts the real savings rate. It shows that there's actually, in real terms, a real diminishment in savings. So people actually save less, but the central bank has fooled the economy into thinking that it has saved more. Why have people saved less? Because the interest rate has decreased. With a decrease in interest, there is a decrease in the reward for people to save money into a bank. And with that decrease in that reward incentive, there is now an increase in the appetite to consume because the opportunity cost has dropped. So in Austrian theory, then, there is a disequilibrium between the real savings and nominal savings or fake savings. The bridge in between the two dots on the bottom is where the credit has been injected into the economy. So now there's a wedge between savings and investment, okay? So real savings is down and to the left on the dot plot of this graph, but investment has now been put into overdrive, shifting to the bottom right. So taking advantage of lowering borrowing cost, because that's what the Fed does, we get more investment into the production process to make more consumer goods. However, savers are actually saving less, which leads to a very interesting problem. While there's more investment into producing more goods, there's now more incentive for consumers to consume more goods. So you have an issue where resources are now being diverged between the production and the consumer process. Again, I'll get to that in the next couple of graphs when it shows the production possibilities frontiers of consumption and investment. This discrepancy between savings and investment, of course, is papered over with newly created money, but that's not really any real resource, okay? So let's move along here and let's start adjusting this to the production possibilities frontier. So here we go. If you remember from tutorial number 1, in the classical model of the old school way of economics, you have your consumers, you have your investors, okay? The more resources that are devoted to consumption, the less for investment. The more that's devoted to investment, the less for consumption. In other words, there's always a trade-off. In order to get a better economy into the future, we have to stave ourselves from trying to have our cake and eat it too now. We got to save it for the future so that we could have more in the future. That's the essence of savings here, okay? But when the central bank starts to increase the money supply, it has an effect on the production possibilities frontier because it shifts the demand curve for investable resources down and to the right, which of course increases in investment. Now, as I mentioned before in tutorial 1, as long as the dots stay on the production possibilities frontier of the consumption and investment model in the top right, then everything's okay. You can invest more, but you're consuming less. But there's a problem. Now we're beginning to see that the dots are actually beginning to split apart. So while there's this momentous shift to the right for investment, for consumers, there's a momentous shift to the left and up to increase consumption. So now it's like resource allocation doesn't know where to go. Do I devote to finishing the final goods for the consumer, or do I devote to investing in earlier stages of production for the investor? And that's the problem that the central bank gives us in their increases in monetary policy. Now, just for a frame of reference, the central bank can do this in reverse when they raise interest rates. Keep that in mind for what the Federal Reserve is doing now. So the wedge between savings and investments is now into a tug of war. Consumers and investors are bidding against each other instead of working with each other in tandem for real limited resources in the economy. So let me put this into perspective for you. The basic problem of modern economics is that they have confused money with real resources, and therefore have equated that more money equals more resources. We tend to look at this today in terms of saying if I have more income, then I'm able to buy more goods. Well, that's only works if those goods are available, and that's where the problem is. Injecting more money does not mean more resources are available. Eventually, you'll run out. That's the essence of Austrian Business Cycle Theory, is the idea to peel away from the monetary facade to take a look at the real world. Now, Keynesians and monetarists tried to accommodate this by adjusting for prices, yes, but as you're going to see later on, prices themselves do not adjust perfectly, contrary to neoclassical and monetarist thought, which is why we get this problem to begin with. Because prices cannot adjust perfectly, because there's no such thing as perfect information in the market, there now becomes an increase in the probability for entrepreneurs and businesses and consumers to commit what are called economic errors. So now what happens is that you have a shift up and to the right in the major dot on the consumption, investment, production possibilities frontier. And what you'll end up having is this dot, which represents the combined resource investment of consumers and investors. It actually shifts beyond the production possibilities frontier. This is unsustainable. But for a time, it looks like we can have our cake and eat it too. This creates what is called the unsustainable boom. So there is an admission among Austrians that when the Federal Reserve lowers the interest rate artificially through money printing, it actually does create growth in the economy, or at least it appears so, but the growth is unsustainable. So it ends up seeing that you might have a pickup in real GDP because there's a discrepancy between prices catching up to new money entering in the economy, but that means that it's fooled our economy into thinking that there's more resources available to do all of this than what is actually available. Now let's move on to the Hayekian triangle with the stages of production in the consumption sector. So here you have a perfectly good right triangle of the production and consumption that represented the original combination of consumption and investment on the production possibilities frontier. However, without sufficient resources to devote to that, we now start seeing that there is a wedge in this triangle. The triangle starts to look distorted. You start seeing a lowering on the consumption line at the very right toward investors, because investors are trying to bid resources away from consumers. But there's actually an increase in demand among the consumers. So now you have a situation where the triangle becomes distorted. What happens in the stages of production? It starts tearing itself apart. Stages of production start being bid toward the final stages for consumption, and it starts bidding away toward the earlier stages for investment, but the tearing apart occurs in the middle stages because the middle stages are divided between consumers and investors. If this goes on indefinitely, eventually there's not enough available in the middle stages to complete the final goods and the economy crashes. To give you sort of a frame of reference of how this can manifest, think about what's been going on in the supply shortages of today right now. Many of the supply shortages of today is because we bid resources to consumption and we bid resources to the earlier stages of production, but we neglected to bid resources to the logistics and transportation and trucking of all of this, which has been causing so much backlog and delays of getting goods here. Why? Because resources have been bid away from that area toward sales and toward manufacturing and construction. So the dynamics of the boom and bust entails both an overinvestment and malinvestment. So the overinvestment occurs in that shift outward of the dot beyond the production possibilities frontiers, but it translates and changes into malinvestment because it's not sustainable. So the investment necessitates that there will be some losses that will appear into the economy sooner or later because it's just not possible to finish all of these new projects that have been undertaken. There's your overinvestment shifted right. The malinvestment occurs in the distorted triangle with the inability to complete these goods. Now, these distortions are then compounded by overconsumption. It's the overconsumption that shifts the dot out actually beyond the production possibilities frontier combined with overinvestment here. So there you have the problem where consumers are taking away necessary resources to complete these new projects that have been undertaken in the capital goods production industry. And because of this, this is what ultimately puts the production possibilities frontier beyond on an unsustainable path that will lead to a breakdown in the economy. The tug of war pits consumers against investors, pushing this economy beyond the PPF, and the low interest rate favors investment, increasingly binding these resource constraints to keep the economy from reaching that extra PPF. So we never get to that extra point. We try to, the economy tries to reach it, but it can't ever actually reach that point. And this is because of the distortion in the production structure of the triangle on the left. In the long run, what happens is that there's a breakdown in the economy, and you actually end up getting a recession or a depression in this, where the economy actually contracts. Why? Because resources were bidded to business projects and ventures that ultimately lead to unprofitable outcomes. So once again, you can see the three graphs here, and you can see how this plays out. Here's the original setup of the classical model. Once you start seeing how the economy acts under credit expansion, you begin to see the fallacies of modern economic thinking here. Okay? There's the shift. There's the shift right caused by the Fed lowering interest rates through printing money. There's the shift outward in the production possibilities frontier. There's the distortion of the Hayekian triangle, and it's just not sustainable. The growth, the real economy cannot reach that point, contrary to what Keynesians think. This is what led to the housing bubble bust. So if we try to apply this to 2005 and 2008, think about it. There was this huge increase in investment to produce houses caused by Alan Greenspan lowering interest rates after the dot-com bubble. It did create more houses, but then what happened? Banks ran out of people to put into houses. So they ended up creating too much. The consumption wasn't there. Why were the consumers not there? They didn't save to buy those houses. They were busy buying other things. They were over-consuming. And so that ended up creating the bust in the long run. Of course, banks tried to keep the party going by lowering credit standards, but then that just amalgamated more losses in the housing sector, creating a worse situation than what would have been, and the entire economy imploded in 2008. Okay? So, let's recap here. In a classical model, if you have a genuine increase in savings, you have consumers and investors work together. So the economy is kept in sync. The dots run along the production possibilities frontier instead of beyond it, creating sustainable economic growth. While true, real GDP in the short run may not move as fast as what the Fed wants it to, in the end, it's going to move faster in the long run. Why? Because we are on a continuously sustainable economic growth. The probability for business people to create economic errors, such as producing the wrong type of product or selling at the wrong price or not meeting the quality needs of the consumer, is much less when it's outside of Fed intervention. But When the Fed does intervene, the probability for economic errors increases drastically. Why? Because consumers are consuming more, investors are investing more than what can actually be finished inside of the real economy. And guys, if you want to read more about this, and I have this book and I have read it, it's excellent. You can buy Roger Garrison's Time and Money, The Macroeconomics of Capital Structure. There has been a revision to this. The latest edition has been 2001. But if you guys want something that's a little bit more recent, you can also read Mark Skousen's The Structure of Production. Both of these works are excellent, and they can provide you a more detailed insight into the Austrian Business Cycle Theory. And again, this is just the basics of the theory. I have not gone into some of the detailed mechanics, but I'll illustrate on that in future tutorials. And the whole reason why I gave you this tutorial setup is to provide the theoretical framework of how I'm constructing my models. From this point forward, I'm probably going to just move on into how I'm collecting and constructing the economic data, and then apply the Austrian business cycle framework to that data to manipulate it to yield what I think is the probable outcomes of our economy based off of the economic data and based off of the forces at play from both the private sector and the public government sector, especially through monetary policy. Guys, I thank you as always for watching this video. If you like the content that I provide, please show me some support. You can always like the video, drop me a comment, let me know how you think and feel about all this, whether you agree or disagree. I would love to learn from you as much as you have learned from me. Always make sure to subscribe to my channel, and as always, click that notification bell so that you're always notified whenever I do upload a new video. Once again, guys, I thank you for watching this, and I'll talk to you next time.